place. Right. So this is the paper that you guys wrote. In all honest, I think it was a little bit different to the normal structures of the papers that they normally examine, right? In the sense that they tested you guys theory questions, right? On the first parts, which is part A, as well as part B, right? Probably that's what could have freaked most of you out. But if you look at it, as you can see, I think question B, it was actually it was a good part. You can see they asked for normal tax, right? Normal tax liability, unless of course you had challenges with the starting off of profit before tax, all right? But I do understand possibly that's what could have thrown some of you guys out, all right? That's fine, right? But in a way, let's just run through it and then see what is going on there. All right. So tax, guys, all right, just to give you a framework. All right, so the first thing that you need to know with regards to tax is you need to understand, like previously mentioned, that there's tax for individuals and then there's tax for companies. All right, that is the first thing that you need to take into account. So the rules that applies to individuals might be different to the rules that applies to companies. The same way with companies, the rules that applies to companies might also be different to the rules that applies to individuals. All right, so it's very important for you to understand what is a company, because when they're examining you guys, they won't say this is a company, apply the rules for company, but it's important for you to pinpoint, right? When am I going to apply the rules for company? When am I going to apply the rules for an individual? Right. So with a company, I'm sure you guys already know, a company is the one that ends with PTY, LTD, right? This is a private company, right? And then, of course, maybe we can just have LTD, right? In this regard, then you know these are companies. But now, when it comes to individual, when you have names, right? Gems, Mr. So-and-so, Miss So-and-so, calculate the income tax of Mr. So-and-so or Miss So-and-so. So in that case, then you know that this is actually taxation for individuals. So you have to apply the rules in that regard. So in today's class, we're going to touch on the side of companies. Right. So in this case, let's look at this question and then see what is happening. So the first part, it says, discuss and calculate the value-added tax, VAT implications of the above mentioned transaction in respect of GS for the 2023 year of assessment. Transaction 1, transaction 2. So that's what we have. And then B says, briefly discuss and calculate the income tax implications of the above mentioned transaction in respect of GS for the 2023 year of assessment. Ignore capital gains tax. So the first part wants you to do the VAT, and then the other part wants you to do the income tax. All right, so let's look at it. Go Springboks Pty Limited, GS is a resident company. So you can see that's a resident company, right? What is the implication of that? I'm sure you guys know that resident company are taxed on worldwide worldwide receipts and payments. All right. So what does it mean? It means if a company is a resident, even if it makes money in another country, that amount needs to be included in gross income. All right. So in this case, that's what it means. All right. If it makes money in Namibia, it needs to be taxed in South Africa. All right. And then GS has shops in all the major cities in the country. GS is a small business. All right, that's something that you also need to pay attention to. So GS is a small business. As defined in terms of Section 12E of the Income Tax Act, as amended. GS is a registered VAT vendor or amounts include VAT unless stated otherwise. All right, so what is the implication of that? Small business. Right, now, when a company is a small business, right, it's very important that we pay attention to the implications that comes with that. Right, so capital allowances, all right, that applies in regards to small businesses. So when you have manufacturing assets, all right? So when you have manufacturing assets, in this regard, you claim your allowances, all right? So you're going to claim 100% on acquisition debt. All right. So in this case, you claim 100% allowance in regards to manufacturing assets. If they acquired manufacturing machinery, you know that, okay, for 30,000, you know that in the year of acquisition, the allowance is going to be 100%. All right. And then non-manufacturing assets. All right. So in this regard, non-manufacturing assets, all right, your allowances now. So you're going to claim 50%, all right, in year one. So that is the year of acquisition. And then you claim another 30% year two, all right. So in this case, if you're preparing your tax for year two, you know that your allowance is 50%. And then in year three, you claim 20%, all right. So that is the difference between a small business and a normal company. Then, so this is with regards to a small business. Now let's look at normal company. All right, just in case maybe, exam, they bring a normal company. So a normal company, all right? So in this case, this is when they don't state in the exam that the company is a small business, all right? They say it is not a small business as defined. So you know that the different rules, all right, that applies now in regards to normal companies. But I'm just going to touch a little bit with regards to manufacturing assets, all right? So we have a manufacturing plant and equipment. All right, so when it's normal company manufacturing plant and equipment, you claim allowances of 40% year one, right? And then you have 20% year two, all right? And then you have another 20% year three, all right? Then you have 20% again year four, all right? So that's what you have in regards to manufacturing assets, all right? So manufacturing equipment, and then we have manufacturing buildings, all right? So you claim 5%, all right, every year, all right? So you claim 5% allowance every year in regards to your manufacturing building, all right? And then if acquired part of a building, all right, if you acquire part of a building, let's take for example, now they don't, in the exam, it's rare for them to tell you that it's part of a building. So they use words such as company ABC acquired first floor, right? First floor of the building. Now already you can see they did not buy the whole building. They only bought first floor, so which makes it part of a building. So you need to pay attention in regards to the wording that they are going to be using in that case. So if a building is acquired, part of it, now your allowance, you claim 55%. So, right, so on cost, all right, so you take 55% on cost, then you multiply by 5% allowance rate, all right? So that is how you go about it in regards to building. And then if acquired part of improvement, right? So when you have part of improvement in regards to manufacturing building, so you claim 30% on cost, so you take the cost price times 30%, right? So so basically that's how we go about it, all right? In regards to the allowances on manufacturing assets. All right, then of course, with regards to normal companies, we also have allowances on section 11E. So it's section 11E, small letter E, not a capital letter E. All right. So in this regard, these ones now depend now on the given table. All right. So they'll give you a table that you then use to calculate your your allowances. All right, so they'll give a table to say maybe it's small teaspoons, your acquired teaspoons, photocopying machines, and all those small items. Delivery vehicles, so in that case, you calculate your allowances now based on the given table that they'll give you then. All right. All right, so in this case, that's what you have for. I'm sure you guys can see now the differences between small business and a normal company. All right, so let's look at the question now that you guys did right. All right. So transaction 1, on 1st of July 22, fixed property that had been used previously was purchased from VAT vendor for an amount of 3,450,000. All right, so the first thing now that you guys had to pay attention to, all right, now do you see this property had been previously used? All right, so it's not a new asset. So you're buying a second-hand property. All right, and then the transaction was not zero rated, and the property consists of land and building. The building was brought into use immediately, and initially 35% utilized for residential purposes. Right, so you have to pay attention, right, in regards to this part of the question. Right, and then the part of the building that was used for residential purpose was leased to outside tenants for 25,000 per month. The remaining 65 of the building is used by GS as a warehouse to store the rugby gear and attire trading stock. Now, there was a lot of things, right, that they brought in regards to this question, which actually I think we can all agree now that there was lots of principles that you guys had to apply. So you have to break it down, right, in regards to this question. So you can see there's 4 marks, right, in regards to this part of the question. So the question wants you to discuss in regards to value-added tax, right? So let's quickly see, all right, in that regards. So let's quickly see now what is going on in terms of this part of the question. So the first thing, all right, that you had to pay attention to is, can you see the first part of the building is used for residential purposes? Now, residential buildings now, all right, residential building in terms of the VAT rules. Now we should know that residential buildings now are actually exempt from VAT. I hope you guys know that, or you pay attention to that. So it's important when you're looking at your notes, right? It's important to understand now that which items are exempt from VAT and which items are zero rated supplies. So that is the first part, all right, in regards to this part of the question. All right, so let's break it down, all right, and then see now and see what is going on in regards to this part of the question. All right, so you start part of the property, all right, so transaction 1. All right, 35% of the building, all right? So 35% is used for residential purposes, all right? So 35% of the building used for residential purposes is exempt from VAT. So it's important that you guys still recall that. We said residential buildings are not subject to VAT. So when you have accommodation, you're leasing out to tenants, there's no VAT. The logic behind that, you have to think about tax in this angle. So the South African government, right, or the revenue system, they come up with a plan to say, now, if we make, right, or if we tax accommodation, it will be expensive. I'm sure already most people cannot afford decent accommodation. So imagine if now they levy VAT on the accommodation. So usually on basic things, there are things that we consume almost on a day-to-day basis. Like, for example, things like bread, milk, transport, right? Remember, even fuel, including accommodation. So you find those transactions, either it's a zero-rated supply or it is exempt from VAT at all. The logic behind that is the government is trying to let people at least earn a little bit of a living. Think about it. There's accommodation, right? And then the government wants VAT. The landlords, what do? Right? The owners of the property, they'll just say, I want my rent maybe 9,000, right? And then they say, okay, on top of that, SARS wants something. So they add VAT on the 9,000. So we should make now this accommodation maybe to be maybe 11.5, 12,000, somewhere around there, making it very expensive. So SARS came up with a system and said, okay, no, we understand, right? To allow people to have a decent living, let's exempt residential accommodation. I believe I gave you guys some good notes, right, in regards to this. Let me just take you through. All right, let me just take you through so that you can see in terms of the note that I gave you guys. So exempt supply. All right, it's important that you take or you pay attention in regards to the list of items which are exempt supplies. All right, so do you see it? So this is our list, which I gave you guys the notes for, of course. So you can see, you run through this. You need to understand these financial services, all right? Supply of dwelling, all right? So this is the guide that's just accommodation. We're talking about accommodation. Transport by road, all right? Educational services, we're referring to your fees that you guys pay. So in this case, that's actually it. These are exempt supplies. In other words, there is no VAT levied at all. So when you're studying now, these are the kind of things that you need to pay attention to. All right. So you saw that, okay, so this accommodation now, it is actually exempt from VAT. So there's no VAT in this regard. Now let's look at the 65% of the accommodation now, which is used for the 65%, which is now used for as a warehouse. All right. So you look at 65%. All right. So it's important now that we look at it and see what is happening in that regard. Right. Also, all right, let me just take you through. Let me just take you through property. All right. I gave you notes on fixed property. All right. So what is going on? All right, in regards to fixed property. So in terms of fixed property, the first thing that we had to evaluate is with regards to the type of VAT. Remember, we are the buyer, right, of the property. So in this regard, the buyer of the property now is going to claim VAT input. All right. So in this case, they claim what we call notional input VAT. All right, that is the VAT which the buyer now was supposed to claim in regards to the property. All right. So in this case, you can then start, all right, GS will claim VAT input, notional. Right, so notional VAT input is just a VAT that is levied on second-hand goods. All right, so this is VAT levied on goods. All right, so that there's a slight difference between the normal VAT that we claim and notional input. So notional VAT input is claimed on second-hand goods. So when somebody buys second-hand goods, we claim notional VAT input. So in this case, you write GS will claim notional VAT input as they acquired the property second-hand. All right. So in this regard, they're going to claim notional VAT input. All right. They bought it second-hand. So in this regard, you start that. All right. Now, what is the next thing that you have to look at. So you can see, of course, in the question, they only gave you the cost price, which is 34.50, but you have to state the notional VAT input is claimed at the lesser of open market value and the purchase price. All right, so you write down the notional VAT input is claimed on the lesser of. On the lesser of what? On the lesser of market value and purchase price. All right. For tax, I told you guys, 90%, if not 100% of the content that they were examining, you guys, you have them on your notes. You don't need to look at the textbook or anything. Everything I gave you. All right. So it's just a matter of saying, did you guys study the notes that I gave you? You can see this is a fixed property. It's there on the notes. All right. So in this regard, you can see in this case now, that's what we have. And then you start, all right? In this case, the notional input, all right, is claimed to the extent of purchase price paid. All right, you also need to state that part, all right? In this case, you're going to claim the VAT input to the extent of the amount that they paid. All right, so in this case, it looks like they paid everything, all right? In this case, there was no need for us to apportion our VAT. So we're just gonna calculate the VAT now on this amount, all right? So in this case, the VAT input, all right, you do your calculation of your VAT input. You take the purchase price, so 34.50 times. Now, you are told in the question that all amounts are inclusive of VAT. Do you see? You're told all the amounts are inclusive of VAT. So what does it mean? If amounts are inclusive of VAT, you then multiply by 15 over 115. Then you multiply now, remember, it's not 100% of the building, but rather 65%. So that is the VAT input now that you had to. So that is the VAT that you had to claim the VAT input in regards to your question for 4 marks. Right, I don't know if there's any question in this regard. So sometimes with your question, we then state time of supply. All right, but of course, I'm not sure if they were awarding mark, but just to be safe, all right? Normally when we have theory question, we state the time of supply. So in this case, the time of supply is the date of the transfer. So in this case, 1st of July, all right? So time of supply is 1st of July. All right. Right. So that's what we have. I don't know if there's any question before we move on. Right. Can you guys see that in terms of this, it wasn't really a difficult question, but let's just kill it for once. All right. And then the other part, it says, briefly discuss and calculate the income tax implications of the above mentioned transaction in respect of GS for the 2023 year of assessment. So I want to look at it in regards to this, all right, in terms of GS now, all right, to see what is going on in terms of the allowances now. All right. So part B, income tax of transaction. Fine. All right. What is the income tax? So the first thing that you need to start, all right, you start GS, all right, cannot deduct the purchase price of, so the purchase price is 34.15. All right, in terms of general deduction formula. as it is of a capital nature. All right. Remember, in terms of your general deduction, what does it mean? It says expenditure and losses actually incurred during the year of assessment, all right, and not of a capital nature. So in regards to this, all right, so it says in terms of section 11A, all right, of course, you guys don't necessarily need to quote that, but it says for an amount to be deducted, it must meet the general deduction formula, which says expenditure and losses actually incurred during the year of assessment, not of a capital nature. So in this case, we know the building is going to be used as a warehouse as well as for rentals. So that would mean now, all right, in regards to this building now, all right, it would mean now that we now have to claim our we can't deduct it because it is of a capital nature. All right. Remember, we're not in the business of buying and selling properties, but rather we are actually in the business of renting out as well as using it as a warehouse. All right. Any questions in this regard? Questions, guys? Right. Now, we want to look at the allowances on building. Right. Now, we have two allowances. All right. So remember, the building, it was a little bit tricky. It wasn't really an easy part, all right, if you want to put it that way. All right. So part of the building is used for residential purposes. As you guys can see, 35% was utilized for residential purposes. So what does it mean in regards to this? So we have two sections, right, that we had to pay attention, right, in regards to these buildings. So in terms of this, let's now look at residential buildings, right? What is the allowance that applies in regards to residential buildings? All right, so we want to look at section 13.6. All right, so in terms of 13.6, in terms of section 13.6, all right, for you now to qualify for an allowance, you should own at least 5 units. Right, you see, in regards to the residential units, right, you should own at least 5 units, and also the units must be acquired new. Right, so you have to write that. Right, GS will not qualify for residential building allowance on 35% of the building, as the building was acquired secondhand. All right, so in regards to this, the building, they bought the building secondhand. So which means now, all right, they can't qualify for that allowance. Right. Now, the next thing now, all right, remember now, they're using the building, all right, for trade, all right? Remember, it's a warehouse, all right? So now they're using it for trade. So when you're reading for text, you need to pay attention now to words like, is it new? All right. So section 13, which is in regards to manufacturing building, as well as buildings used for trade. All right. So in this regard, if the building is used wholly or mainly, that is more than 50%, all right, for purposes of trade. So in this regard, your allowance now will be 5%. So now I want you guys to see now, right, in regards to this, with respect to the building, 65% of the building. used as a warehouse. All right. So allowance, all right, would be 5% on cost. And also in this regard, which is 34,50,000. And also they'll claim allowance of this much. So we're going to take 5% times 34,50. All right. Excuse me. 5% times 34,50 minus what? Minus the VAT that we previously claimed. Remember, we calculate our allowances now on amounts that is excluding VAT. So we have to deduct the VAT that we calculated up there. So we take the cost of the building minus VAT. So 292,500. So this is what will then give us our allowance that we're going to claim in regards to the building. I don't know if there's anyone who is lost in this regard. So we're going to claim this allowance, right, in terms of this part of the question. Okay. And then what else do we have? So rental income, right? Remember, they're collecting some rental income. So the part of the building that was used for residential purposes was leased to outside tenants for 25,000 per month. So we're collecting rental. So from which month do you see? 1st of July. Then you check what is the year end. Right? So in regards to this, it's quite important to pay attention to the year end of the company. All right. So in terms of this, did they state? Do you see the financial year ends on last day of March? You know, so which means now we need to calculate rent from July. So we have July, August, September, October, November, December, January, February, March. That will take us to 9 months. So we have rental income. All right. So the rental income now is going to be 25,000 times 9. In this case, that's what we have. All right. This will be negative, the other one will be positive. So rental income, so you write including gross income. All right. Including gross income, right? So that's what we have in regards to your part of the building. All right. Cool, guys. And then let's move on to the next part, which is transaction 2. On 30 April 22, Ciacolis, the sole shareholder of GS, sold shopping fittings to GS for 322,000. So what is going on? The sole shareholder, all right? So sold shop fittings to GS. Now, in terms of VAT, right, VAT, you need to understand why they're telling you about the words like the sole shareholder. Now, the moment you see words like sole shareholder, what are they trying to tell you? You need to understand now that SIA and GS are connected persons. So you first write down SIA and GS are connected persons. All right? As SIA is sole shareholder. So it means now this guy is the owner of this company. All right? He holds all the shares in this company. All right? So which makes it now the main owner of the company. So that would mean now, all right, in terms of this now, we now need to look at some transactions now to see what is happening in terms of this. So we have now a connected person, all right? And then they sold now for 322, and the open market value on the date of sale is 240,000. So which means GS is purchasing from a connected person, all right? So in terms of this, there is VAT input, but it's coming from a connected person. So at what price are we going to claim VAT input? So we claim VAT input at the lower of cost and market value. All right. So VAT input from connected person is calculated at lower of cost and market value. Right, let me just quickly see if I have that in the notes as well. Okay. You see, so connected person, all right? Consideration less than open market value or for no consideration. Now you claim VAT input, all right? In this regard, buy claim 100% input tax, then consideration equal to open market value. So in this regard, our buyer, all right, who is GS, is a connected person. So which means now GS is going to claim VAT input at the market value, which is the lesser, that is 240,000. All right, so VAT input. All right. So in this regard, you're going to take 240,000. Oh, sorry, yes, 240,000. Times. All right, so in this case, you then have to multiply now by, we need to multiply now by 15 over 115. Remember, all the amounts are inclusive of that, 15 over 115. And then let's look at, is SIA now, GS going to use these items 100% for taxable supplies? All right, so the fittings were brought into use by GS, all right? SIA is not a VAT vendor according to binding ruling. The showman did not match. Right, so let's quickly look at here at the back of the question. Is our taxpayer making 100% taxable supplies? All right, that's what we need to also pay attention to. All right. So in terms of this, looks like they did not really state, right, if we make 100% taxable supplies or not. So there's no need to apportion our VAT. So let's assume that they told us that SIA makes 70% taxable supplies. So we're going to multiply our VAT input by the 70%. But however, in our question, they did not state, right? So which means our taxpayer is just going to claim VAT input on this amount. Right, so that's what we have as our VAT input that comes with the first transaction. Right. All right, and then let's now look at normal income tax. Right, what are the normal income tax that comes with transaction 2? So with normal income tax, you need to think about gross income, you need to think about the deduction, you need to think about the allowances. All right, so in terms of this, SIA sold shop fittings to GS for 322. The fittings had originally cost SIA 345. The fittings were brought into use by GS on 1st of August 2022. SIA policy is not a VAT vendor according to General Binding Ruling number 7. Shop fittings are written off of a period of 6 years. So there's a lot of things now that you have to look at. The first thing, all right, remember we just bought shop fittings. You write down the purchase of shop fittings is of a capital nature, therefore is not deductible in terms of general deduction formula. So it's not deductible in terms of the general deduction formula. So in this case, so we don't have any deduction. And then we look at allowances on shop fittings. So I think the catch in regards to this now So they gave us the allowances, which they told us the general binding ruling number 7. If GS was a normal company, we're going to divide over 6 years. All right, so the allowance was going to be claimed on 6 years. But however, now the problem now, all right, is now that this property which they just bought, all right, is now it is actually now acquired now by a small business. So which means the rules for small businesses now will apply. Remember, we said with the small business corporation, when it acquires an asset in the first year, it claims 50% allowance. So in this case, we should mean allowance now. All right. It's not important to write down the section. The examiners know that you guys don't use the legislation, so you might not really know the section. So what's important is for you to just take 50%, 50% of what? 50% of 240. All right, let's just quickly look at it. All right, let me just see if I have 11E. Sorry, 12E. Right, so this is what I have in terms of small businesses. All right, so we have our allowances. All right, you can see now small business. All right, so you can see now the allowance. All right, 100% in the year that the asset is brought into use. That is, if it's manufacturing, and then non-manufacturing assets, you claim 50%, 30%, 20%. Right, so in this regard, it's important that you guys pay attention to that. But in all honesty, if I have to be honest, it was a little bit tricky, right? In the sense that you have to run around your mind in order to pick out that this is actually a small business, right? So we have 240 inclusive of VAT. So we need to deduct the VAT, which is 31304, right? So then we get our capital allowance, not a portion for part of a year. So this is the allowance that we are going to claim in this first year. Any questions, guys? So I can say the first question, it was not really an easy question. I think there was a little bit of integration. So I can say it was a technical type of question, all right? But one thing I love about text, even though question 1 was a little bit technical, you could have scooped marks on question 2. Right? You could have collected a lot of marks in regards to question 2. Right. And then let's look at the shop fittings did not match the other fittings and were sold by GS on 31 January 2023 for 110,000. All right. So they are selling it to Austin. Right? So this regard, which means now upon the sale, there is VAT output. All right. So we have to discuss in this regard, discuss about that sale as well. So sale of the fittings. All right. So in this regard, VAT output. So GS will levy VAT output on selling price. All right. So they sold the fittings. All right. Remember, you claim VAT input when you buy, and then VAT output when you sell. So in this regards, let's now look at the VAT output that comes now in regards to the sell. All right. So they're selling at how much? So they're selling at 110,000. Do you see? Excluding VAT. All right. So they're selling 110,000, excluding VAT, which means now multiply by 15%. We don't use 115. Why? Because the amount does not include VAT. Right. So VAT output will be that. All right. And then what is the implication that comes with the sell? All right. So sell of fittings. All right. So GS will include equipment in gross income. All right. Remember, the question says ignore the capital gains tax. So you have to calculate now the calculation of recoupment. All right, there's so many ways that one can calculate recoupment. All right, but I prefer the easier method, right? And we just say selling price limited to cost less tax base, tax value, I mean. So in this case, selling price limited to cost. Right? So in other words, the lesser between the selling price and the cost. So in this case, selling price is 110, so the cost is 240. So which means we're just going to use 110, right? So selling price limited to cost. So it will take us to 110. All right, and then tax value. All right, so in this case, tax value is cost. So our cost now we say is equivalent to 240 minus 31304. So this is what will give us the cost. All right, it takes us there, and then allowances. All right, so the allowances claimed 2023. So in this case, only we had one allowance. So it was 104,348. All right, so we net off these two amounts in order to get the tax value. All right, so that's what will give us our tax value. So it will be sitting at this amount. Right, we have that is our tax value. All right, which would mean now recoupment. All right, so we calculate recoupment whenever we make a sale of a capital allowance. All right, so in this case, we have recoupment, which is sitting at this amount. So what is recoupment? It's SARS which is coming in and say, hey, you previously claimed allowances. All right, so now I want to tax you on the allowances that you previously claimed. All right, so that's what we mean by recoupment. All right, anyways, any questions before we proceed now to the next question? Right. So part B, right, here comes part B. What is it saying? So part B says, calculate the normal tax liability of Go Springboks, right, for the 2023 start with net profit before tax, right? So in this case, we have part B, all right? So we have net profit before tax, all right? So in terms of this, the net profit before tax now is 2,548,000, all right? So 2,548,638, all right? 2,548,638. So that is our starting point. Now, in terms of this question was a little bit different to the other questions that we have done. All right. How is it different? It is different in the sense that now there are accounting rules, right, which may be different to taxation. Let's take, for example, depreciation. Accountants calculate depreciation. We can all agree that when calculating net profit, accountants calculate depreciation. But SARS doesn't calculate depreciation. So SARS calculate wear-and-tear allowances. So which would mean now you first have to reverse accounting transactions, which are different to tax. Example, depreciation. All right, profit on sale. All right, remember when you sell an asset, accountants calculate profit, but SARS will come and say, let's calculate recoupment, let's calculate capital gains tax. So those are the differences that we have to pay attention to. So and then we also have things like interest, local interest. Accountants treat local interest as an expense, all right? But, and then local interest received, accountants treat it as income. Then SARS will come in and say local interest is exempt, all right? So in this case, those are some of the rules now that we have in terms of sorry, local dividends, I mean, not interest. Remember, interest for companies is actually not exempt. It's only interest for individuals, which is exempt. All right. And then you have other things as well that you have to pay attention to. So let's quickly look at it and see now what transpired. All right. So in terms of this, so we have the receipts. All right, this is what we have, the sales. So normally in terms of the sales, the rules are the same. Sales is the same sales for accountants and SaaS. And then we have gross dividends received from a local company, which is sitting at 46,022. Now, the problem with gross dividends, accountants treat it as income, but SaaS would come in and say, include gross dividends in gross income, then you exempt it. So which means now, all right, accountants included this, all right, in the calculation of profit. SaaS is also going to include it, but SaaS will go on as well and then say exempt. So you have to deduct them. These are local dividends. So 46,022. I don't know if I'm making sense to you guys. I understand sometimes in terms of these calculations, we just used to studying with the SaaS way, all right? But it's important to be flexible to understand the differences between SaaS and accountants, all right? And then we have expenditure, all right? So do you see purchase of raw materials, all right? So in this regard, there's purchase of raw materials, including VAT. Do you see? So there's purchase of raw materials, which is that. Now, both SaaS and accountants deduct purchase of raw materials. These are purchases. But the only problem now is this amount includes VAT. All right? So we have to deduct that. So VAT on raw materials. So we have to remove the VAT now that is included on the purchase price of raw material. So how do we remove it? It was previously deducted, this amount, it was expenditure. So we have to add it back. So 1428.76. All right. So this amount, it was previously deducted. Remember, purchases we deduct them. So which means this amount was deducted, but however, it was incorrect. All right, it was incorrect with this amount. So we have to add it back. Or alternatively, what you could have done, somebody could have said, purchase of raw material, this amount includes VAT. So I'm going to add it back. Then you do the calculation of the correct amount that excludes VAT. So it's still fine. All right. And then 2, we have doubtful debts. Then they referred us there. Now let's quickly look at it, all right, to see now in terms of this, what is going on, all right, in terms of the doubtful debts. All right. So with respect to so the doubtful debt, all right, but all right, it's fine. Let's start with doubtful debt, then we'll come to inventory. So at the end of the financial year, the company's IFRS 9 loss allowance relating to impairment equal to its lifetime expected credit loss was 58,400. Lease receivables were excluded from the debt figure used in calculating the allowance. Now, so the allowance which accountants calculate is different to the allowance which SaaS use. So what do we do now in regards to this? So we have to reverse doubtful debt allowance that SaaS deducted there. So we have doubtful debt allowance. All right. So SaaS, so accountants deducted 58,400. So we have to add it back. Right. And then we have SaaS allowance. Now, I believe I also gave you guys notes in terms of allowances for doubtful debt. All right. If you go to I think it's corporate rules, if I'm not mistaken, on your slides. We said doubtful debt. If a company applies IFRS 9, all right, you need to look now, you need to evaluate in terms of that. If it's a lifetime expected credit loss, we multiply that loss by 40%. So the allowance now, it was supposed to be 58,400 times 40%. So this is the allowance now, which SARS was going to grant you. Right. And no, this question it wasn't really that straightforward. All right. That's why I said even earlier on that our exam wasn't as straightforward as we might want. All right. But still at the same time, it was still doable, though parts that you could have fetched marks. All right. And then let's look at inventory. It looks like inventory, the accountants never included anything in regards to the inventory. Do you see inventory on 1st of April at the beginning? All right. So in regards to this, on 1st of April, all right, so we have opening inventory. All right, they never included that. So opening inventory. So in this case, we're going to include it. So it's at the lower of cost and market value. So included lower of. All right, that's the amount that we include when you're dealing with the calculation. Both accountants and SARS, they use the same rule. So what is the lesser now? It's 658. All right, 658,741. All right. So in this regard, this is opening inventory. So what do we do with opening inventory? We deduct it. Then we have closing inventory. All right. So in terms of closing inventory, we're still going to use lower of cost and market value. All right. So in terms of this, in terms of the opening inventory, we're still going to use lower of cost and market value. So we're sitting with 852 and 842. So the lower is 842. All right, so we're gonna get it 842,965. Right, so that's what we're going to add back. Then after that we have design acquired. All right, so do you see the design acquired? So in terms of this design acquired, the account is deducted 125. So let's quickly see in terms of this now, what is happening in terms of this. All right. So the design on 1st of June 22, GS purchased a new design for rugby jerseys from a big food supplier in South Africa for an amount of 125. Now, do you see account is deducted 125? But what does SARS say? Design is of a capital nature. You qualify for allowance of 10% in regards to design. You know, so in regards to this, so cost of design. All right. So you can write down capital in nature. All right. So you reverse that. So in this case, we need to reverse that. 125,000. So we add it back because accountants deducted it. And then allowance on design. Right, let me just quickly check. I know it's 10%, but just to guide you guys. Sometimes I saw recently they've been giving you guys the rates at the end of the question. Just quickly see if they didn't give you the allowances. It looks like they did not give it. Okay, let's see. Yeah, looks like they did not give it to you guys. That's unfortunate, of course. Let me just say. Yes, I missed it. Yeah, it looks like they did not give you guys. All right, sorry about that. I know sometimes they give at the back of the question paper, all right? But you guys did not receive the allowance. So the 10% you're supposed to know it, but I do recall, all right, I gave it to you guys. I don't think it's this one, but let me just quickly see, all right? If it's here. Here is the other one. All right, the other part. Let me just quickly check it for you guys. It should be corporate tax. Okay. I'll share with you, but I know it's under corporate tax, should be part 2 of it, right? And then the trading stock, of course, I believe you guys still recall that you use the lesser of cost and open market value, you know, so you're still going to use it in that regard. All right. So that's what we have, all right, in terms of the design, all right, and then we have interest paid, then they referred us to form. All right, let's quickly look at it and see. So interest on bank overdraft, we find the leasehold improvement. All right, so we have interest that is coming on bank overdraft. So we can all agree that, of course, interest is actually deductible. All right, interest on overdraft is deductible, so no need to worry. But now, excuse me, interest on SARS account that is in arrears. So now, interest on SARS, right? That's a penalty. Right, so the penalties now, they're actually exempt, or what we call prohibited deduction. All right. So in this case, remember, fines and penalties, they're prohibited deduction. So SARS was not going to grant you the deduction, so you have to add it back. So 2687. So you have 2687, which is sitting in as a prohibited deduction. Right. So I've seen that's what we have, and then depreciation. So no doubt about it, depreciation threat is an accounting transaction. So which means you have to add it back. So depreciation is sitting at 268,744. Right. So that's what you have. Of course, you're sitting with depreciation, but we have to also consider now if there was some form of allowances in regards to those assets that you have depreciation. So let's quickly go to 5 and see what's happening. All right. So 5, we have the accountant calculated the depreciation for the 2023 year of assessment is this. A second-hand machine was purchased at a total cost of 480 on 1st of August 2021 and was brought into use on 2 September 2021. Due to the change in industry regulation, machine A had to be sold and was replaced with another new and unused manufacturing machine B. Machine A was sold for 525, excluding VAT on 30 October 22, and machine B was purchased at a cost of 747 on 15 October 22 and brought into use on 1st of February 2023. So in regards to this, right, this was replacement assets. So there was a lot of principles that you had to look at, all right, in regards to this. So there was so much that you could have done in regards to this. So the first thing, you have machine A, all right? All right, so machine A is being sold. So now, what do you do in regards to the machine that is being sold? So one, you have to determine now the capital allowance. Right? Even though you're selling this asset, but you're still going to claim the capital allowances. All right? So in terms of this, it was purchased for 480. All right? Do you see it was purchased second-hand? Now, look at your company. Is it a normal company? All right? Or is it a small business? Now, they changed, all right, in terms of this. It was important also to pay attention to reading. All amounts exclude VAT unless stated otherwise, and the company is not a small business. Do you see? But at the top, on question 1, it was a small business. It was still called GS, but now they're calling it's no longer a small business. That was also another catch that you guys experienced in the exam. So it's important, right, to pay attention. So here, it's not a small business, and then it was bought second-hand. So which means now you're going to claim allowance of 20%. All right, so 480 times 20%. It's a manufacturing asset. So in this case, it was bought second-hand, so you claim allowance of 480 times 20%. So it will take you to this amount. All right, so that's what you have. And then this machine was sold, so which means now you have to do a calculation of recoupment in regards to this asset. So selling price limited to cost. All right, so this regard, so you take selling price limited to cost. Let's quickly see what do we have in terms of this. So they sold the machine, right, for 525. All right, so 525, and then the cost is 480. So you're going to use 480 in this regard. So we have 480,000, right, and then your tax value. So tax value, you're going to take cost, which is 480, all right, less allowances. All right, so allowances, so the allowance that was claimed in the year that they bought it, all right, remember, they bought it on 1st of August 2021. All right, what is our year of assessment? So in this case, 2023 year of assessment. So you just quickly check, all right, for the 2023. So all information per day relates to B, all right, except for the following. So in this regard, which means the year is 31 March, all right, 2023. So in this case, which means now we're going to calculate our allowance for 2022. All right, so 2022, so it's 480 times 20%. All right. All right, and then 2023, you also have 480 times 20%. Still give you the same amount. So you have it sitting there, and then you net off these amounts to get your tax value. All right, so it's cost minus these allowances. That's what will give you tax value. So it's sitting there. All right. And then that means your recoupment is going to be 480 minus 288. All right, so that's what will give you your recoupment. All right, but unfortunately now this asset was replaced. It was a replacement asset. I don't know, to the guys who attend the normal class, all right, you remember we spoke about replacement assets. All right, so in this case now, all right, the asset now was replaced, so which means the recoupment is claimed to the extent of the replacement asset. All right, so replacement. All right, so recoupment. All right, so you're going to calculate it 192 times, so you're going to multiply it now. Let's look at the allowance for the new asset. What is going to be the allowance of machine B, which is the replacement asset? So machine B was actually bought new and unused, so which means we're going to claim 40% in the year that we bought. So that means our equipment that's taxable in the current year will be 40%. So 192,000 times 40%. All right. So that's what we have in regards to equipment. Then we have capital gains. All right, in regards to machine B. So proceeds. All right. So you're going to take the selling price minus the recoupment. All right. So in this case, the selling price now for machine is sitting at, they sold it for 525. All right, minus recoupment, which is 192. All right, so it takes us to this amount, 525 minus 192. All right. So you take us there. All right, so to give us this balance, and then best cost. So the best cost, of course, there were no additional cost, so which means the best cost now will still be the same as the tax value. So it's 288. Right, which means you have your capital gain, which is sitting at this. So your capital gain is this. All right, that's what we have as our capital gain. All right, so we have it there. All right, and then in regards to the capital gain, you just have to wait to see if there's any other capital gain, but I don't think there was any other asset that was sold. All right, so in this case, let's just deal with it. So the capital gain, so taxable capital gain. So we're going to include now 45,000. We also multiply by the allowance. Remember, you're going to claim an allowance of 40%. All right, so in regards to the capital gain, so it'll be 45,000 times 40%, and then you multiply also by your capital gain rate, which is 80%. Remember, companies' taxable capital gains is calculated at 80%. All right, so you have 45,000 times 40% times 80%. All right, so then give us this amount. And then machine B. All right, so you have machine B. All right, so in terms of machine B, what is going on? All right, so cost of machine B. So instead it's capital in nature. So no allowance. All right, so you're not going to get allowance there. And then allowance. In this case, how much is our allowance that we are going to get for machine B? So the machine B, we bought it now at a total cost of 747. All right, so we have 747. Right, let's see, is this amount inclusive of VAT? All right, it's very important to pay attention of that. All right, so in this case, all amounts exclude VAT unless stated otherwise. So we can assume that this amount now does not include VAT. All right, so we just have to deal with the calculation. We have 747. All right, times 40%. Just reporting you. All right, in this case, its allowance would be that. Right, it will take us to this amount. That's what we have in regards to machine B. And then we have delivery vehicle. Right, so the delivery vehicle, that's what we have. So in this case, we bought it on 30 August for 256. Right, but now, these ones, they qualify for Section 11E allowances. All right, so these ones, these are small assets. So we divide by the general ruling binding period of 4 years. All right, so we're going to divide by 4. Then we apportion. Whenever we use general ruling, all right, allowance, when we calculate allowance based on the general ruling, we always remember that you have to apportion now your allowance. So it was bought in August, so we have September, October, November, December, January, February, March. So we used it for 7 months, so multiply by 7 out of 12. Right, so that's what would take us to 256 divided by 4 times 7 out of 12. Right, it will take us there. All right, so that's what we have. And then let's look at leasehold improvement, all right, to see what transpired there. All right, so in terms of leasehold improvement, so we just have rent paid, which is 250. All right, so let's see what happened there. All right, GS signed a new lease agreement on 1st of June with France. The lease agreement is for a period of 5 years with the option to extend the lease for another 3 years. All right, The agreement included a monthly rent of 25,000 payable on the first day of each month from the 1st of June. The new lease agreement stipulated that GS had to effect improvements of 458. The company commenced with the leasehold improvement on 1st of July 22, and they were completed 30 November to the cost of 560. Right, so there's a lot of things that we have to look at. All right, so in this case, let's first look at the rental, right, that was paid. So in terms of this, the rental that was paid is 25,000. So times, so it was ended on 1st of June. So there was June, July, August, September, October, November, December, January, February, March. So that's like 10 months. So 250 times 10. So in this case, in terms of the rental, it's fine, right? So the rental paid is correct, all right? So everything is fine, all right? No adjustment. So the issue now was on leasehold improvement. So let's pay attention in regards to the leasehold improvement. What does the standard say? So leasehold improvement, all right? The lessee will get an allowance on the leasehold improvement done on behalf of lessor. So if you do an improvement, you're a tenant, you carry out an improvement on behalf of the lessor. So in that case now, the standard now states that you're going to claim allowance, all right, in regards to the leasehold improvement. But now, the allowance now is going to be claimed on what? Leasehold improvement is claimed on agreed lease amount. All right, so you're going to find out now, in this case, the agreed lease amount between GS and France is how much. So they agreed that the improvement should cost 458. You see, but however, GS went on now to spend 560. So which means the leasehold improvement allowance is going to be calculated on the agreed amount. All right, so allowance, all right, leasehold improvement allowance. So they agreed 458. Right, now the 458 now is claimed over the remaining lease term. Right, so it's important now for us to understand. So the lease, they entered into a lease, right, which is for 3 years. So which is for 5 years. So 5 years is what? 60 months, right? So the lease is for 60 months. We also include the option to extend. You know, so in this case, 60 months plus 3 years. 3 years is 36 months. I'm just saying 3 times 12. So in this case, so total number of total lease period. Don't worry, I'm almost done. All right. And one slide. So total lease period. So in this case, we have 5 years times 12 plus 3 times 12. All right. So in this case, we have 5 times 12 plus 3 times 12. Right, so it will take us to 96. Less used period. Remember, we said we use the remaining period. So in this case, up until completion date, how many months have lapsed? So in this case, the completion is on 30 November. So what is the remaining period of the lease? So from June, all right? Remember, they entered in the lease on 1st of June. So we have June, July, August, September, October, November. So it takes us to, it's 6 months, right? I believe you guys can see that. All right, so when did they enter into the lease? All right. Oh, there's a new lease. Right? The new lease agreement. Okay, no, it's fine. It's 10. Remember, they entered on this debt. So it's 10. All right. So in this case, there's 6 months which just lapsed. All right. So which means the remaining period is going to be 90 months. All right. So in this case, the allowance now is going to be claimed over 90 times. So this is going to be claimed from when was it completed? November. So you have October, sorry, December, January, February, March, which would take us to 4 months. So multiply by 4. So the leasehold improvement now, that's how we go about it. Right, so it will take us to this amount, and then assessed loss, and assessed loss of 62 was brought forward from the 2022. So we have assessed loss as well. Right, so in this regard, it's sitting at 62,800. Right, then it will give us taxable income. Just net of ones. Any questions, guys? I'm sure you guys can see it wasn't really an easy paper. All right, if I have to be honest with you guys, it was not really the standard that we normally expect, but it was a little bit challenging, but at the same time, I believe it was doable as well. So this is taxable income. Remember, we are looking for, so that's our taxable income. So we need no more tax at 20%, oh, sorry, 27%. 27% times this amount takes us there. Oh, sorry, mistake. It's not negative, it's positive. All right, and then less provisional tax. So the provisional tax is 3,568,800. All right, so then we have no more tax liability like this. All right, so this is what was expected of us, right, on the exam. I don't know if there's any question in this regard. Right, but I assume your exam is going to be a little bit different to this paper, right? That's what I believe. So, of course, we just do this to prepare you guys. Right. Questions, guys, before we close. Yeah. Cool, guys. So if you guys don't have any question, I can say have a lovely evening. You're going to find out that I'm going to make some adjustments to the timetable. We're going to have another class for text as well this week. All right. So that's what we have in regards to this part.
Sorry, Ian, are we having a class on Saturday?
Yes, I have to. I'm actually going to remove MAC. Not I'll replace it with text. So I have to include the text in that regard. All right. Any questions, guys?
No questions, Ian. Thanks.
All right. Pleasure, guys. All right. Have a good evening, guys. I'll see you again soon. Bye, guys.